Okay, so I said the first thing we'll be looking at is price action. So what are price action? What is price action? By definition, price action is defined as the movement of price over a given time frame. All right. In general, everything that is happening in the market, everything that is happening on the chart is as a result as a result of price action. Everything you can tell from the chart is as a result of price action. All right. As a trader, your success in trading is directly proportional to the knowledge you have about price action. It tells you how the market move over a particular time frame. For example, the chart I have before me is GBP USD. All right. So when for me to make any decision of either to sell this market or to buy this market, I need to understand what the price action is saying. And as a trader, you should note that it is risky for you to trade against what the price action is saying. Okay, so with the knowledge of price action, you will be able to tell the direction of the market and where you intend to, like the decision you are supposed to take, either to take a buy or a sell position in the market. Is more or less talking about market trend. But price action is beyond market trend. Market trend simply tells you the direction of the market, but price action speaks more of the overview, the entirety of what the price is doing over a particular period of time. Okay, I hope that is taken. So for example, in order for me to make a decision on this particular pair, I need to study price action. Price action also involves understanding the technicality of what price is doing per time. Okay. For example, we've already talked about chart patterns. I measure things like double top or double bottom. If you can remember when we treated chart pattern, I talked about flags and all of those things. So it is the knowledge of price action that helps, that in fact that is the fundamental basis of what you are supposed to know as an analyst, because it will help you, it will guide you in decision making. Okay, so when I look at this particular chart, I can see that the market is a kind of downtrend within this region and this region, and there is a bit of consolidation within this region and this region. All right, so since okay, if I am to take any decision based on what I am seeing, what I'm currently doing is what I am studying the price action. All right, I'm studying what price is doing at this particular period of time. I'm at the 1 hour time frame. So within this time frame, whatever decision I am making is based on what price action is saying. So I hope that is taken. I hope that is taken. So it is important to know that trading against what the price action is saying is risky as a trader, and price action is virtually everything that happens in the market, like I rightly said. So the next thing we have on our list is what? The difference between an oscillator and an indicator. But before I just give you the difference, I would like to lay more emphasis on oscillator, because before now we've treated indicator, but we've not been able to cover oscillator. So I will have to explain to you what it is, and then when you know the meaning of what oscillator is, you will be able to distinguish it between indicator and what? You will be able to distinguish it from indicator, and you can tell the difference between an oscillator and an indicator. All right. So what is oscillator? Oscillator is a technical indicator that gravitates between levels on a price. Okay, what I mean by that is oscillator, they are also indicator. All right. You have to, please don't get it wrong. Just follow what I'm saying. I'm sure you're going to get it at the end of my explanation. Oscillator are actually indicator. They are technical indicator. The reason why I use the word technical is because indicator is also a tool used in technical analysis. So oscillators are also technical indicators, and what they actually does is that they gravitate or move or oscillate. You know, when we say something is oscillating, for example, when you have I don't know if you guys have seen a simple pendulum or a pendulum bob. It's just doing something like this, up, sorry, you will say something like this, up, down, up, down, up, down, up, down, up, down. So it's confined within a particular zone, within a particular number. All right. So this is how you see oscillator moving on your chart. Okay, for when you open your MT5, your MetaTrader, there is a place where you can add indicator. There are some certain indicator that when you add them, they are going to they will be displaying at the or towards the ending part of your screen. They will be displaying there. And what you will see is that you will see them, you will see two lines, two bounded lines. For example, when you go to your chart, for you to understand what I'm saying clearly, at the end of this class, open your MetaTrader 5 and go to the portion where you can see your indicator and add RSI. When you add RSI, you find out that that RSI is actually an indicator, but it is also an oscillator. It's an oscillator indicator, all right? Because it is bounded within two zones and it oscillates or gravitates within those particular zones. And one of the important things oscillator help us to do is that they show the point of an overbought or an oversold. For example, whenever we see that, if this is what I have drawn here is an oscillator, whenever I see that price is tending to cross over this zone or price is around this level, it is an area of what? Overbought. And whenever I see price around this region, this particular place, either trying to cross it to the downside also, is an area of overbought, all right? So, and what does this information help us to do? When you discover an area of overbought in the market, it's an indication that reversal is probable within that particular direction. All right. So whenever price tends to come to an overbought region, price tends to reverse from that particular place. So when you look at your oscillator and it's telling you you are able to interpret that, okay, this oscillator is at the overbought region. The information you are to derive from it is that there are tendencies that market will start reversing from that particular level. All right. So it is very, very important. Meanwhile, having said all of this, it is not advisable for you to trade them in isolation. Okay. I'm not saying you should open your charts, then add one oscillator and then begin to observe them. Once they come to an overbought, you begin to sell, or when you see them in an oversold region, you begin to buy. No, there are other confluence that you have to add to it before you can make that prediction valid. All right, don't trade them in isolation. So that is that about what an oscillator is. So having explained what an oscillator is, we already talked about what indicators are already. All right, indicator actually lagging markets. They use what has happened in the past, just like the blueprint of what the market have done in the past. Then they tend to predict what the market is doing per time. The major difference now between an oscillator and an indicator is that why oscillator tends to show an area of overbought and oversold, an indicator can act or show the trend of the market. All right. For example, when you look at my chart, you can observe two lines that is moving on the chart. So that is an example of an indicator. That is an example of an indicator. All right. So you can see that in as much as we are able to interpret this market as a bearish market, the indicator is also following that market trend. Why an oscillator cannot do that? Okay, an oscillator cannot do that. And from what I have said so far, it is right for you to conclude or infer that all oscillator are indicator, but not all indicators are oscillator. I'll take that again. From what I've said so far, I said we can infer or conclude that all oscillators are technical indicators, but not all indicators are oscillators. I hope that is taken. I hope that is taken. Now, the next thing we have on our list is EMA indicator. What does that mean? EMA actually means exponential moving average. All right. Exponential moving average is a type of indicator. Okay, so what you are seeing on my screen, this line you are seeing on my screen actually is an example of what exponential moving average indicator are. So what is the meaning of it? It is actually the average movement of a price of a particular currency pair based on a certain number of candles. I'll take that again. Moving average indicator or exponential moving average is the movement or the moving, sorry, please. Moving average indicator or exponential moving average is defined as the average movement of price of a particular currency pair based on a certain number of candles. I'll take it again. It is the average movement of some particular currency pair based on a certain number of candles. For example, when you are using 20 moving average, if you are using MA or exponential moving, for exponential moving, the exponential moving average, they occur in pairs. All right, they are always of two. You can have some that are three in number. You can have some that are single. When it is single, you can simply call it moving average. But when you have more than two or more than one, you can call it as exponential moving average. All right. So how it works is this. When you look at my chart, you have two lines. Okay, look at this place where my pointer is. These are the, I'm sorry. These are the two moving average that I have. You will see here is written DEMA 8. All right. What this thing is telling you is that it is an 8-period exponential moving average. Why this one is telling you that it is a 21-period exponential moving average. All right. So how do you use it? So please pay attention to this part. When you want to use EMA or exponential moving average as can I call it as a strategy of trading, meanwhile, like I said, indicator are lagging markets, it is not advisable to base your analysis on indicator. There are other confluence that you are supposed to add, but just for you to have the knowledge of how it is used, you will observe that whenever the smaller period is crossing over the larger period, for example, we have the 8-period moving average and the 21-period moving average. So the color of the, I need to check the color for you to Okay, okay. The blue color represents the 8 period, moving average, while the red color represents the 21. So how you trade with this indicator is that first you have to study what the overall trend is saying. Like you go to your higher time frame. When I talked about the concept of multi-time frame analysis, I told you guys that your higher time frame is meant for your analysis, while your lower time frame is meant for your entries. After running your analysis on the lower time frame, on the higher time frame, you scale down to the lower time frame to spot where you want to make entry from. So for you to be able to use this exponential moving average, what you need to do is go to your lower time frame, be it daily or 4 hour, then try to know what market structure is saying. All right, what do I mean by that? Try to understand the overall trend of the market. That is the first thing. Then remember, there is a popular saying that says the trend is your friend. As a trader, you are not supposed to forget that. The trend is your friend. What does that mean? That you should always trade alongside with the trend. Okay? You should always trade alongside with the trend. Having said that, after checking for the overall trend of the market, you scale down to your entry time frame. Basically, if I am to use this exponential moving average, I prefer the 1 hour time frame or the 30-minute time frame. All right, that is my own personal. That is the one that I've tested, and I know that at least it's working to an extent. Although I'm not an indicator trader, but just to explain to you how I use it when there is need to. So I'll go to my entry time frame after I have known the overall trend of the market. Then whenever I see the smaller period moving average crossing over the bigger one to the upside, if it is in alignment with the overall trend, I will take the buy. I hope you guys are taking note of what I am saying. I hope you understand what I've said so far. I'll take that again. The first thing is you go to your higher time frame to check the overall trend. This time around, let's assume that the overall trend of this market is bullish. Okay, so what I will do is that for every point I observe that the smaller period moving average is crossing over the bigger one, I will look for a buy position. Do you understand? For example, look at this region. Look at this region. This particular level. What you can see there is, you see the blue line. I hope you guys are seeing it clearly. You see the blue line crossing over the red line to the upside. The blue line represents the smaller one, while the big one, the red line represents the bigger one. So whenever I make that observation, I will start looking for how to make entry for a buy. And if you would have made this entry from here, you would have made a huge profit, because if I'm entering from this particular line, this particular spot where it crosses the bigger one to the upside, I will have a long position. I'll have a long position here, and then my SL is just going to be below that rejection candle. I've told you candlestick, all right? Then what am I going to target? I'm going to target this nearest. I don't want to be greedy, like I said. Always don't try to be greedy with the market. Just take your profits when it is appreciable. Okay, I'll just target this particular high. And if you would have made that entry, you would have made some money. Okay, you have made some money. That is about how many risk to reward ratio. So that is how to use the exponential moving average. Now, if I want to take a sell, and you look at this particular region, where this particular zone, you will find out that the green line, sorry, the blue line, which is the smaller time frame, is crossing the bigger one. All right. So what I will look for, that is if I want to, although it is not advisable to trade against the trend, it is not advisable, it is risky. If we remember what we are working on, our assumption is that the market is bullish. All right. So we shouldn't take, it's not advisable to trade against what the overall market is saying. But if the overall market is bearish, and I make this observation from here, and I made this observation from here, I am going to take a short position. Once I immediately see that this candle closes down and the 8 period, which is the smaller one, has crossed the big moving average, I will just take my short position from this zone. And what will I target? I will target the nearest supply. There's a concept called imbalances. There's a concept called imbalances in the Forex market. With time, I'm sure you are going to understand that, because I'm looking at this place. I'm looking at that particular level. Sorry, please. This particular line, I'm looking at it as what? Liquidity. You mean there's a concept called liquidity. So for those that the people that trade supply and demand, they will understand that concept. But with time, as we proceed, we are going to unveil all of these things to you guys. Okay, so there is a concept called supply and demand. Using that concept, if I want to target, I can target this particular place, because this is where the nearest demand is, where the market is buying from, while supply is where the market is selling from. They are more or less your support and your resistance. All right, so there's no big deal in the name. Okay, so I will just target this particular level, because this is where I can see the nearest demand. And what happened if I would have made that particular entry, placing my SL just above this weak rejection, it would have been a good trade. Okay, so this is how you trade using your exponential moving average. Some people may decide to use probably 20 or 21 to 50. What that means is that if I'm using 21 to 50, it means that the smaller line will take the period of 21, while the bigger line will take the period of 20. We take the bigger number, which is what, 50. So when I said 8 period or 8 exponential moving average or 8 period exponential moving average, what that means is that that particular line is calculating the average of 8 candles. I'll take that again. Whenever you see or you come across any statement, or when I said 8 period moving average, what it means is that the line you are seeing is calculating the average of 8 candles. Okay, I hope that is taken. And if I said 50 period moving average, it means that it is calculate the average number or the average value of 50 candles. So this is what exponential moving average is all about and how you can trade them. All right, so this is all we have for the day. If there is any question, I will receive them on the comments. I'll wait for it on the comments box. And just as a reminder, some of us have asked for videos concerning the previous classes and some certain questions personal peculiar to you guys. I've been receiving some questions lately from some of your colleagues and all of those things. So what I decided to do is I'm going to, once I am done, because those videos, I try to recreate some of them, the ones that I'm not able to record. And then I'm going to find a way to load them in a particular page and send the link to you guys, so that whenever you are in need of the previous one, any section, I do it in such a way that whichever one you are looking for, you can see it, all right? You can see it in that particular loop. For example, if you are looking for candlestick anatomy, you will see it there. If you are looking for market structure, you see it there. So yeah, I'll try as much as I can to make that available for you guys. And don't forget, make sure you're trading. This is a new year, and I expect